thank you to our panelists on the precious metal session for joining us today. So we have Wayne Gordon, Senior Investment Analyst, Chief Investment Office at Global Wealth Management at UBS. Sean Thompson, Vice President, Corporate Development and IR at Westhaven Gold Corp. David Williams, Executive Chairman at Thomson Resources. And Calvin Wong, Independent Analyst. So thank you for joining me here today. And so to kick things off, it would be great to get a short bio from each of our panelists. Tell me a little bit about yourselves and what you're focused on. Calvin.
Okay, I'll start first, yeah. All right, so basically I'm actually independent analyst right now in strategies. So prior to that, I worked for both the sell side and the buy side. So close to 15 years in the market, or 17 years if you take into this year as a consideration. So primary focus on global macro. That means I look at the broader picture. That means related to FX, commodities, which is gold is one of them, and as well as the stock indices and fixed income. So right now I'm actually looking potentially with my partner to start up a fund for AI.
David Williams. So I've been running ASX listed companies for over 25 years. Started life in oil and gas, moved to the dark side of uranium, which I love, and then into hard rock and principally on gold. But with Thomson, we launched in 2019 into silver. Seeing the opportunities for silver. Can't get away from gold, we've got a bit of gold. So we're in that phase of pulling together some previously mined areas with deposits through a hub and spoke approach and getting them producing silver and a bit of gold alongside.
Okay, Wayne Gordon from UBS Chief Investment Office. Primarily, I'm a multi-asset strategist, so I look across the board at any opportunities that we think are possible, and we have a sort of a 6 to 12 month horizon. I specialise in natural resources, which includes gold. I look across the board at both equities, commodities, as well as fixed income in the resources space. So we tried to find those opportunities in there. So yeah.
Sean Thompson, Vice President, Corporate Development and Investor Relations for Westhaven Gold Corp. 3 years ago, I was at the 1-to-1 Singapore over at the Fullerton, and I was with a company called Atlantic Gold Corporation. We got taken over by St. Barbara for $800 million, so that was a nice transaction. It was actually announced on the day of the conference. Previous to that, I was with a company called Kaminak Gold Corporation, which got acquired by Goldcorp, which is now Newmont for $500 million. So I've been very fortunate in the last 5-6 years, and I believe that Westhaven Gold Corp's got the next big takeover transaction on the horizon. That's it.
All right, make a note to talk about M&A a little bit later. So recent announcements by the U.S. Fed note that they're going to be focusing on fighting inflation and so keeping interest rates high for the time being. How has this impacted the precious metals markets, and where do you see market sentiment heading? Maybe, Calvin, if you'd like to kick us off.
Yeah, sure, definitely. So definitely for sure, we're talking about gold itself has been facing a lot of downside pressure. But if you look at gold itself being quoted by the dollar, which is USD, yeah, definitely it's facing downside pressure. So we're talking about from an all-time high in about August 2020, which is 2075. And this time around on the onside of the Ukraine and Russia crisis, which is early March 2022, failure to break above 2075. Then all the way down, we see it drop down close to about 16.15 last week. So that's about 20% decline. But if you look at it very interestingly, if you look at gold against yen, gold against Chinese yuan, CNH, or even gold against sterling. So in fact, against this currency over here, X dollar, it seems to be that gold is actually pushing up higher. So that's actually interestingly, there's actually other factors that are actually supporting gold, which is geopolitical risk, financial repression. But definitely due to this current king dollar supremacy, that's actually depressing gold price against the USD.
Yeah, I guess I'd definitely agree with that. I think we started the year bearish gold, and we had a price target of 1,600 to 1,650. We reached that level earlier, and but in that context, when we put in our assumptions at the beginning of the year, we certainly didn't expect to see the level of dollar strength that we've seen, and we certainly didn't also expect to see real interest rates rise as quick as what they have in the US. And of course, there's been a lot of movement of the COGS over the last 6 to 9 months. I think the key for us is obviously we were wrong in the first quarter, and then we've been right for the last couple of quarters. I think the key is that, and particularly just referencing the views there, I guess the key thing for me is how quickly can inflation come down in the US? And that will determine a couple of things. Firstly, obviously how aggressive the Fed will be over the next sort of 3 to 6 months. And thereafter, how aggressive they are, how quickly the US does slow down, how quickly the labour market can deteriorate in the US and therefore lead to a potential recession in 2023. And all of that time, I think it's going to be very difficult to bring inflation down to the Fed's target. So I guess what we're looking for from a point where we can start to think about playing gold as a hedge against the pending downturn is more about when does the Fed begin to focus more on growth relative to killing inflation. The reasons we believe inflation stays more elevated for longer is because we think there are structural constraints on the supply side, which will continue to hold up prices. Some of that is on the real estate side as well. And so we think that persistent inflation will be there. We just believe that the Fed inevitably will pivot towards trying to support or at least slow down its pace of rate hikes. At that point, we think gold can start to perform again. But as I say, finding that point is going to be very difficult. And I don't expect that to occur until at least we're moving into the second quarter of next year.
Yeah, I think the interesting thing on the supply side and touching on the inflation aspect is, of course, everyone's worried about the costs and the costs of opening up new resources and those that are operating. And bear in mind, it wasn't that long ago that the gold price was in triple figures, not quadruple figures. And so there's a lot of what would have been marginal mines opening up, and we sort of see a lot of smaller deposits in Australia being reworked because of the high price. But if your costs are going through, and I remember at one of the 1-to-1 panels, I think it was the London one, they were talking about who they'd invest in, and it would be not producing on the silver side, not producing, but on the developing, because you've got the chance to wait until inflation settles down, your costs settle down, and the prices start going up. But if everyone's holding back, when's it going to be ready? When's it going to happen? So I think it's a bit, you've got that sort of balance. And then we were talking about earlier is then you've got countries like Australia that are doing something quite different, governments like Australia doing quite different. And we saw the spike in the interest rates by the Feds. And then the RBA, the Australian Bank, announced at only 25 basis points. And the ASX jumped 3%. And you think, hang on, that's interest rates are going up. But it was less than what they were expecting.
Absolutely. I think that's spot on. I think the interesting thing from our side is with gold, you've got to put on two hats. So the first hat is from a commodity standpoint. The second hat is from an asset allocation standpoint. And this is where, even within my asset allocation standpoint, I'm protecting the downside in clients' portfolios in their holdings of physical gold. But at the same time, we are holding those physical allocations to gold because of as we said, the ongoing geopolitical risks, the risks of over-tightening by many central banks, the risks of policy mistakes, as we've seen in the UK, for example. And so from our perspective, yes, if I just think about it purely from a commodity standpoint, I'm more bullish oil today than I am bullish gold. But from an asset allocation perspective, as we talked about before, when we think about different currencies, different assets, when you look at gold's performance relative to equities, for example, gold has actually held up very well. And so it has that ongoing sort of, I suppose, hedge in a portfolio context. Yeah.
Yeah, definitely. So allow me to add on a fair bit of it. So if you look at our current economic, we call it context right now. So definitely for sure, I mean, we're not going to kid ourselves that inflation is no longer transitory. So definitely it's persistency right now for inflation. So if you look back past in the history, definitely in high inflation times, gold is definitely one of the asset class that actually outperform the rest, even equities as in general. So 1970, 1980, this was a period of high inflation. So for this 10-year period, in fact, if you look back at the chart for gold spot per USD, that spot, gold price actually very close to about 2,000%. That is tremendous. That is actually much more higher during the, we call it the emerging market bull run. That's where China going to the trade WTO. That's around the start of early 2002 to 2008, 09. So what's interesting about gold right now is over here is that there's actually a fear in the market about holding gold, which is the opportunity cost. That means if you look at the real cost of holding gold, that means you're talking about, let's say you take the 10-year US Treasury yield, you minus off the break-even rate, which is the future expectation. So you get that real rate. So if you look at that real rate itself, right, in the last 8 years has been negative persistency, negative. So everyone say that, hey, this negative boundary may stay long, sticky enough. But you look at the way the Fed start to guide the market and the speed of this adjustment is tremendous. So within the span of less than 3 to 4 months, from negative, it actually went all the way up to a high of positive 1.6% recently. So that was not a high seen in, I think, August 2009, prior to the great financial crisis. So that actually created a lot of fear when market starts to actually adjust this cost of holding, real cost of holding gold, that is putting downside pressure in gold prices right now. So one thing to add is, what's interesting over here is that the forward rate, that means the break-even rate of the 5 and 10 year, in fact, has started to slow down. So think about this break-even rate is that what is US inflation will be in 5 to 10 years' time. So the Fed start hiking rate definitely since the start of, I think, March this year. They make it clear cut. So ever since for March this year, the 5 and 10 year actually slide down. So I think from about 3.6% to 3.2%, it went all the way down to, I think, current price, I think yesterday was around 2. If my memory serves me right, it's about 2.2% to 2.15%. Yeah, so that's coming very close to the Fed target of 2%. But strangely, it seems to me that current guidance from the Fed, even the last night or this week, they're not happy with these forward-looking rates. They're not happy to it. So eventually, what we are seeing right now is that the Fed want to push this rate much further. Perhaps we're looking at maybe 1.9%, if those who are looking at technical analysis, 1.9% on the 5 year. So that could be a potential point where you could see a change in the Fed policy then. So it's something that I'm keeping close eye watch on it on the 5 year break even.
I'd just like to revisit the point that Wayne was making about the physical holding. And of course, it's a topic that's dear to the heart of any silver person. That holding physical, and I think we're probably going to talk later on about cryptos and virtual currencies and so on. But there's always that focus on holding physical gold. And we're seeing that focus on holding physical silver as the poor man's precious metal. And yet, you listen to the conspiracy theorists, and I think there's a fair bit of weight to what they say, is that a lot of people are getting into silver, but they're not taking physical possession of it. They're not taking delivery of it. And so we actually see the silver market being quite manipulated in the sense of, I think people think there's a lot more physical silver out there than there actually is. And it seems to be less of an issue with gold because people seem to be more concerned about actually having the gold. I'm interested in your comment on that. Whereas silver at the moment, is it real? Where's it coming from? Who's got it? And with this changing geopolitical situation, someone was saying the other month about China having $3 trillion worth of US Treasury bonds, I think, and Russia had, to a lesser degree, that problem and then monetized it into physical. What's China going to do if it's going to start invading Taiwan or the like? But whereas they seem to trade silver a lot more, and there seems to be a lot of virtual silver, what happens when people say, well, where is it? And I think that's what we see in silver, a lot more of that manipulation of the price, where we see that less in gold.
So let's try to answer the question for the audience. Where's the gold price going, right? You guys are analysts. It's based on Fed policy, like you said. Let's say they back off in 2023. They get to 4.5%, 5%. They're happy. Is this when gold starts to finally have its move? What do you think?
Geez, you asked me all the hard questions. Huh? Good Lord.
Well, you never-
Okay, so I'm. I think that you can find a base in gold at that point. But while policy, or at least why quantitative tightening continues, so even if rate hikes slow or stop, as long as the Fed has an ambition to reduce its balance sheet materially, at least back to the place where it was prior to the COVID-19 crisis beginning, you're still going to see ongoing contraction of liquidity, at least in certain pockets. And that sort of, in some ways, while inflation continues to come down, and as I said at the beginning, I think it's very difficult to get inflation back to where it was without a severe recession. I think if you end up with a severe contraction globally, yes, inflation can come down very, very quickly. But without a severe contraction in the global economy, remembering that China is probably going to recover next year, so there's some offset to the slowdown in at least we have our fingers crossed that there's some offset to the slowdown in developed markets. But as long as the Fed continue to try and reduce the balance sheet, that is very difficult to then suggest that real interest rates can start going the other way quickly. Because even at the headline level, if they start coming down, if inflation's coming down at the same time, real interest rates stay where they are. I think that we made a very good point at the beginning with respect to the dollar. I think the dollar has done an enormous amount of damage across all commodities, actually, to be fair, including copper, oil, a whole range of things. And so I think that once you get a turn in the dollar, then you can see gold stabilise and see gold begin to come back to, at least we think, stabilise around the 1600, 1650 mark. Because if you just follow real rates and the dollar and you put that against gold prices today should be trading at 1300 as an example, right? Now it's not. And it's not for the reasons we talk about, the geopolitical risks, the risks on inflation remaining elevated for longer, et cetera, et cetera. And so I think to really get gold moving higher, back towards that 2000, if not higher, you either need a very sharp deterioration of the global economy, some geopolitical risk, of course, and the Fed beginning to cut rates. And I think that's what puts the spark under gold, because then they'll stop trying to remove liquidity from the market.
And we've got two big reports coming up soon that's going to help answer this. We've got the CPI.
Non-farm payrolls.
And we've got the jobs.
Absolutely.
So let's just say the jobs numbers come in, not so good, and the Fed's going, okay, it's working, we're slowing things down. Let's say the CPI comes in a little lower than previous. This could be the beginnings of a rally, maybe?
Yes. Yeah, it could be. I think the rally we've seen over the last couple of days, where it got down to, I think we mentioned it, 1630 or whatever the number was, and then it got back to around 1730 or so. I think that in part was around people saw the JOLTS report. They thought, job market's starting to slow a bit.
Short covering, likely. That was probably a short move, right?
Yes.
You look at managed money. My partner sent me the COT report. Managed money is net short by a lot of contracts. So
makes a big difference.
Yeah, maybe the recent move was short covering. Maybe there's more to come.
Yeah, and the rubber band gets pulled, and eventually you get a bit of relief, as you say. Yeah.
So you never ask a junior mining promoter what he thinks the price of gold's going to do, because we'll always say it's going to $3,000.
Well, actually,
right? But I should have an opinion. So
yeah. Well, no, I think your question is also interesting from the perspective that gold equities. Often we buy gold and gold equities together. Right, and you have a lot of dislocations around the world in various prices versus the companies that produce those items and so on. But gold equities and gold tend to trade quite in line with each
the,
other.
the equities give you that extra lift because of the leverage
Absolutely.
inherent in them. And,
Yeah.
yeah.
And that was going to be my point, is that the gold equity side, and sorry to take your the thunder here, Andy, the gold equity side, and then the silver part, because silver is double the volatility of gold. So quite often it follows the trajectory of gold in price sense. So, what do you guys think about, the prospects of these things? Because your point about net short positions is a good one. So there could be quite a bit of upside.
It's really, from my opinion, it's almost irrelevant what I think gold's going to do. Is it going to go up, down, neutral? Our job is to drill holes in the ground and find gold and build resources and hopefully get acquired by a larger company. We're hoping to find 10 million ounces of gold in the ground in British Columbia, where we're operating. We've got a good discovery off a highway close to a city. A shameful plug for West Haven Gold here, of course. But so at 1,700, 1,800 gold, as long as we find a lot of it, we're still going to make money. Our shareholders are still going to make money. So that's what we care about mostly. I don't know.
But to the point that was raised, are costs a constraint, and labour a constraint, and materials a constraint to you at the moment?
100%. But given our location right off a highway near a city, we're a low-cost explorer. We drill at $300 a meter, which is lowest decile in our space. You can probably attest that's pretty decent for drilling costs. We're fortunate in that sense. So other explorers, other producers that are having to deal with cost inflation, yikes, look out. It's getting pretty bad out there.
Yeah, it's an easy life being a gold explorer miner. You try doing it for silver, you don't know what's going to happen. But coming back to your point about where the US dollar is going, and of course in Australia, we watch sort of the silver price come down or the gold come down. But in Australian dollar terms, it's actually going up. And so from a cost perspective, balancing what the potential revenue is, we're in not bad shape. But silver is that strange one. Typically, it's been a lot more volatile than gold. When gold runs, silver runs harder. When gold comes down, silver runs down harder. But this last few days, even the week, it's been really strange, where we've seen that volatility in gold, but silver has sort of come up when gold was doing nothing and has flat lined. The gold-silver ratio, which is something dear to my heart, was sitting up there about 97 and then came down below 80, and it's sitting around 82 at the moment. Now, it shouldn't be there. It should be more like 30. Well, I'd like it to be. But I think it's also demonstrating that transition or that difference that's happening with silver. I mean, it will always be a precious metal, but it's that control for the technology metal side of it now we're starting to see influence it. And I think that's what we were starting to see a bit more of that disjunct. And I think it's going to be really interesting when gold does go for that run, that inevitable run, where everyone else is saying, well, we would expect silver to run just as hard, if not harder. I'm not sure it actually will. And that becomes interesting for it in not just its tech metal side or the new age metals is often called, but what will that do for the precious metal? Because we're going to see more of a disjunct because it's not going with gold. It's not being that additional precious metal to gold, and where do you get it all, particularly if people are after physical. So I think on the silver side we're going to see that change coming on.
I think that's a very interesting point to make, especially on the recent movement of silver, if you take it to the last 5 years as well. So is it a possibility that from you guys in the mining space is that there's actually a structural change for the demand of silver? But that traditionally gold itself is usually for jewelry, at the end of the day it's a hedge for inflation, hedge for geopolitical risk. Well, silver itself, it can be used for other usage, if I'm right.
Yeah, look, no, I think that's and that's what we got into silver for. It's that the movement to solar panels, to electric vehicles, 5G, and the use of it, because silver is the best conductor of electricity, and it's very pliable. It's very good for reflection. It's got its medicinal qualities and so on. But it's that new age requirement that's going to drive it, and 75% of the world's silver production is as a byproduct. So it's not sensitive to supply and demand. It's sensitive to the supply and demand of the associated mineral, which might be gold. Typically it'll be zinc or lead or sometimes copper. And that sort of drives it. And so the producers are producing more or less of the primary commodity, and well, silver just happens to be there. And so you get to a time a bit like at the moment where, for the issues with China and COVID lockdowns and so on, that there's not the demand, the actual demand for it. That's tapered off a bit. It will be there later on, and you're getting the build-up of the silver for the industrial usage, and so that's a cap on the price. But then when that takes off, if it's not taking off with the other minerals, then you're going to say, well, hang on, where's the silver going to come from? Because you've got nothing that's responsive to what that supply and demand is. And again, I think that's what's making it very volatile as well, as to, you could have a lot of silver in the market, then you might not have much silver in the market. And there are some big projects around and big deposits around, but from a political risk perspective, they're often in countries or areas that people are a bit cautious about getting into. But where are you going to find the supplies? Where's the next big discovery of lots of minerals, not the least of which gold and silver? And
this is probably one of Amy's next topics.
All right, you guys keep going.
I'm
I'll just stand here.
I'm leading you to the next topic, but it's a perfect segue into it, because there is a scarcity, there's a lack of new discoveries in gold, in silver, in several metals. Big miners, they're depleting their resources on a daily basis. Where are these new deposits going to come from? I mean, it comes from junior explorers and exploration companies and developers, and it's getting harder and harder to find new good gold discoveries, especially in safe jurisdictions like Canada or Australia, the US. That are meeting ESG requirements, that are not environmentally destructive, good locations. Cost is a big factor. You got to have a good location, easy access. Getting harder and harder to find.
But I think that's, we saw it particularly in Australia when the gold prices went from languishing down at 250, 300, 400 US to into the four figures. All of a sudden, people thought, well, hang on, I don't know where I'm going to find the next discovery, but gee, there was a working down there that they operated, and then they shut it down when the gold price went down to 250. Or maybe I'll go back and have a look at it. And so we've seen in Australia, in Western Australia and Northern Territory more recently, people coming back because the price is up. So you're getting this aggregation of a lot of smaller projects, and essentially that's what we're doing on the silver perspective, of taking these areas that were worked back in the late 1800s, early 1900s, and say, well, they're not going to work where they are with that size resource, but if you bring them all together, you're starting to get something of scale. So I think we'll start to see a lot more of that revisiting. We'll start to see a lot more of that thinking outside the box of, well, how can I make something work by bringing it together, or looking at what else is associated with it, and bringing that on. Getting smarter as an industry, which is only going to happen with the juniors. The big boys are not going to come in. They're not going to go and do something that we're doing.
I guess I'd like to ask you guys, actually. Sorry, Amy, but I'd like to ask you guys. So the reaction function from big miners has changed. So this is the interesting thing we've noticed also with copper. You mentioned the commingled metals. And with copper, etc., what we've noticed is that even though the expectations for demand are very, very strong because of EVs and electrification of grids and trying to move to the low carbon economy, even though copper prices, they've come. Just as an example, if you had said to me, you're going to have a crash in China housing, and the copper price would be trading at $7,800, which I think it was $7,600 it is today, I would have said, no, it has to dip into the cost curve at some point. But it hasn't. It's held up at these levels, similar to what gold has as well, actually, and silver similarly. You would expect that with real interest rates were to go to 1.1, 1.2, the dollar's trading is at strongest level in 30 years or maybe more. I would have said silver would be trading at 13, gold would be trading at 1,200, 1,300. I think in the last down cycle when we did QT last time. Gold got down to what, 1100 or something like that, I think, in the trough. So it seems to me that there's this constraint, and then companies want to pay dividends. They're buying shares back. They're not investing particularly the big companies, not investing in exploration as much as they used to, and it has come down to the smaller miners. How do you think this plays out? How do you think this plays out?
They have to compete. The big gold companies now with Wall Street and big financial funds in London, they got to say, how are we competing against Apple and Microsoft and all these tech players that are growing, and banks and everything else that's paying dividends? So they're kind of forced to do this. With regards to new discoveries and our business, I think part of the reason the price maybe is sticky, to your point, is that the all-in sustaining cost average of a lot of these producers is probably 11 or 1,200 an ounce. If gold starts to get down towards that or lower, they're just going to curtail production. It's going to stop. That's it. We're not making any money. So I think they're still making a healthy margin here at these levels. I think they're able to give money back to shareholders in the forms of small dividends and buybacks. Whether that continues or not here, this is going to be, again, back to our Fed policy and what rates are doing and stuff. But I think the companies are still making money here, and maybe it's not being shown in share prices and things like that. But as of now, it's still okay.
And the ESG issues as well?
Yeah. Well, just to finish off on that, and I'll come back to the ESG, but I think two aspects of that, and that, I've worked across a number of industries. I've worked in oil and gas. I've actually worked in pharmaceutical development. And in both of those industries, it was very much about big pharma, using a small pharma to develop the more risky stages of a pharmaceutical development. In oil and gas, we would often find big oil working with small oil to go and do things. I remember some guys from Exxon saying to me one day, look, David, your company can go exploring that because you don't have to tick the boxes I have to tick. But if you can do that and get that happening, then we're in and we'll take over. I've not seen that in minerals, and I'm still skeptical as to whether we will see it. And I think a lot of that is that in the case of oil and gas, for example, or in the case of pharmaceutical, there's still potentially that big discovery there. In minerals, I think pretty much we know what's there, other than the needle in the haystack somewhere, the porphyry targets, and which is beyond the junior. And I think even things that we find are just not of a scale that big miner is used to or want to do. On the precious metal side, again, I think while part of it, what I see while we're seeing it staying up is, again, not that supply and demand on those other pressures you're talking about. It is that concern about what's real. And I know we're going to come on to it later on with that fake currency called crypto, which I still don't understand, but I'm sure I'll get educated. I think you're seeing that growing, and I'm sure that that's sort of helping to bolster it. On the ESG side, I was talking to someone about this earlier. I mean, we've started the ESG journey simply because we know we've got to get there. And if you start early, like a lot of these things, you build in that culture. It's much easier when you're actually into that producing side. Practical reality is, in countries like Canada and Australia particularly, and the US, it's not a big shift for us. We're doing that sort of stuff. The environmental controls are pretty much there. What I find hardest is getting emails from our shareholders saying, why are you wasting your time on this ESG stuff? It's rubbish, spend your money on drilling holes and whatever it is. And I'm saying, well, hang on. The serious investors in the Northern Hemisphere want to see you heading down ESG. And that practical reality is we should all be doing it.
Mandated now. Like funds have to, they can't invest in something unless they have a strong ESG corporate governance initiative. So we kind of, companies are forced to do it. We like to think that we just do it naturally. We've been working in this area for 15 years. We employ the local First Nations. They got good, high-paying jobs. Everyone's happy. It's not just playing ESG dress up for us. We live it. This is our staff. This is the community we're in. But you do have to be careful of the ESG dress up thing too, right? Because a lot of companies do that.
Yeah, precisely. So I think that's the strange phenomenon about this ESG premium that everybody's get hyped up about. So particularly in Singapore with the family offices that I engage with, so everybody's talking about ESG. Is this company, what's that ESG factor of this company? And the funny thing about ESG factor is not like credit risk factor where you have unified ratings, but ratings are so diverse that you can't have a proper, we call it score, ESG score for a particular company like Rio Tinto. I mean, there's one rating company can give a good score, another company can give a bad score from here. So the thing about this ESG, unfortunately, is I do believe that it's here to stay because of various economies, various country big push to it. And whether it's good or bad, we shall see in the next 5 to 10 years. But definitely, I believe in the near term, I believe that right now, even the banks are forced to actually use ESG factor to decide you guys the cost of funding if you want to get from the banks itself. And even I think even you want to raise funds like a rights issue or even a new minor to the IPO, you need to disclose your ESG risk inside your prospectus. And if I'm not wrong, certain jurisdiction you need to highlight the font size.
And you wonder what it's going to do to gold companies in the future as ESG gets more and more, prominent and important. Gold companies are funny because you mine this stuff. It consumes a mass amount of electricity and power, and
Precisely.
and it has a big environmental footprint. And really, what you're doing is you're pulling out and making gold bars that go into a vault back underground again. And it's kind of like, what are you guys doing here? Is this really worth doing? Right? It's like, do we need this?
But you're missing the important part of that, because what you're going to do with your gold mine is you're going to put a whole lot of solar panels there. So you're going to need more silver. And so what you're doing is you're propping up the silver industry.
There you go. Crypto. Should we go there?
Yeah. Oh, we have a question from the audience.
Yeah, so my question is, will crypto be a threat to gold and silver? Some background stories that people that I know, anyone that 35 and below, none of them are investing in gold or silver, and all of them are doing cryptos.
They will be soon after they get totally burnt on crypto. And coming back to the point I made before, sorry, fellas, jumping in, but what sits behind crypto and what sits behind a virtual currency. And I think we're seeing more and more concern as to, and okay, you see it from the older people, but I'm also starting to see it as it trends down. And the closest friend of my son is a Singaporean, and he's working now with a company that he called it stable crypto, I think it was, where there's actually sort of matched or linked to physical dollars coming in. But then when you look at it, that's just paper. The thing with gold and with silver, well, it should be with silver, but with gold and silver is it's real, it's solid, and you've got that backing behind it. And I think we're going to see more, and we're going to see it more at that younger generation as they get burnt. Not everyone will get burnt, but a number will get burnt, that they'll be looking for what actually sits behind it, what is real and what is not able to be manipulated, manipulated in the sense of a currency which goes up and down with a particular country and how that goes. Whereas crypto is universal. It's global. Gold and silver are global and universal. And it seems to me that that's the sort of matching, the opportunity that's going to be there. And that's, I think, in the long run is going to help gold and silver, because that's going to increase the demand.
Up until recently, it has been a threat. Up until the recent gold correction, in my business, just capital raising, general level of interest. And you're right, it was a fascinating point, is what you said, under 35, right? They're into crypto. This is what the younger generation likes. And I think that they love the volatility. I mean, you look at gold from, let's think back, 2012, gold was, essentially where it is today. It hasn't really moved that much on a percentage basis. You look at Bitcoin or something back in 2012, it's a couple dollars, and it goes up to 48.50. These are 1,000%. This is big volatility. I think these young guys like this, young guys and girls. I mean, it's what's popular. It's what's being traded. I guess it comes down to, what do you trust as a store of value, right? Do you trust in computer programs and algorithms and the blockchain? Do you trust in gold and gold miners, or do you trust in the government and fiat currency and paper, right? What do you trust?
Yeah, I think just to add on over here, it's a very interesting point over here. So just to make over here is that definitely for the younger investors, like 35 and below, even though I'm not that young, I do have some stake in crypto. So we talk about cryptocurrency over here, we talk about digital gold will be definitely Bitcoin, then digital silver will be Ethereum, and down the line, down the chain. Yeah? So the thing about why cryptocurrency gains such popularity, we talk about number one is a cultural thing. One thing for the culture. What's culture? Because definitely we talk about the younger generation associated crypto as freedom. Okay? Freedom from the establishment, freedom from the current centralized governance that is being governed by the Fed and the various central bank. So what happened causes the great financial crisis was actually due to this centralized governance that lead to subprime crisis, everything. Then you have people who have this big conspiracy theory, saying the company with the letter G is the big, vampire sucking around there. So this gives rise to the popularity of what you call it crypto, Bitcoin, and Ethereum to actually change the world financial system. So this gives a lift up. Then definitely on top of that, you start to see speculative mania coming into the picture. You have scam, you have people who start doing ICO, celebrity, endorsing some dodgy coin, you call it. So that is in the heart and we call it a truth of a tradable asset. So I view the current situation right now in cryptocurrency and what we see in the past, what happened to the gold in the 1970s and 1980s. So if you look back 1970s and 1980s, gold volatility is very high. It's one way up. So this particular 10-year period is associated with hyperinflation. That means, i.e., they're actually blaming, number one, central government for not doing a good job of inflation. Dollar is worthless. They call it banana notes. So that gives a new cultural sense that, hey, money got to go go is the next that in thing at that period of time. And during that period of time, you start to see a lot of scammers as well. But unfortunately, at the time, there's no digital thing, IT.
Yeah, it happened in Canada, Quadriga CX.
Correct,
Remember
precisely.
that?
If you look back in history, so there was a lot
The
of
guy
dodgy
went to
money.
India, apparently died, and no one could get their money out. I'm from Canada. I had an account at a Quadriga, a small one, very small, frozen. The guy died, apparently died, had the code, the wallet, whatever, was controlled by him, and no one could get millions of dollars lost. Quadriga CX, I'd like to know, Wayne, what do you think from UBS perspective here on crypto?
Okay, I was hoping you wouldn't ask that question. Okay, so thinking about it relative to gold, I think it's incorrect to look at crypto and gold as something that's interchangeable. So from our perspective, I agree with you. When crypto was rallying quite sharply through the COVID-19 crisis, we had a lot of our second generation clients who their parents have been intergenerational holders of gold, were very interested in crypto. And that interest is definitely still there. But the reason you hold gold and the reason you hold crypto are very different. And that for some reason, whether it's by mistake or by sort of some quirky reporting, there's been this sort of link, is Bitcoin the new digital gold, for example? And now that relationship in many ways was drawn because both have finite amounts, i.e. we're not really making gold globally. Yes, we have a lot in vaults, but the earth is not generating gold as quick as we take it out. And of course, Bitcoin is limited. So I think to make that comparison between the two is very difficult, and I don't like to perpetuate that, I guess. The couple of things I would say is that that at the moment at least has a benefit for gold relative to crypto, in a general sense, is regulation is one thing. So we still, policymakers are still landing on where regulation is going to sit with respect to digital currencies from a central bank perspective, for example, as well as where these other digital currencies are going to be. And that may not just be Bitcoin, but that might be Ethereum. It might be a whole range of other derivations of that. So regulation is still very uncertain for cryptos. Relative to gold, where regulation is relatively stable. That would be the first point. The second point is that crypto hasn't performed well in periods where liquidity is being withdrawn from the market. And what we've seen is that crypto, when we've modelled this as a contribution to a portfolio, which is what we're really interested in, we want to know how both gold, crypto, any asset, as we add it to a portfolio, we want to increase the Sharpe rate, or we want the thing to contribute to a portfolio without just contributing volatility, etc. And so from our perspective, when we've added crypto into a portfolio context, it contributes tremendously when you have periods of quantitative easing, for example, or monetary policy easiness. But of course, when monetary policy starts to tighten, all it does is contribute significant amounts of volatility into a portfolio without actually contributing to material return. Now, in gold, over different cycles, we have shown that gold has much lower volatility, around the sort of 15% or so on average over time. And it actually, over all parts of the cycle, it still provides a contribution to diversification. And so that's the key for us with respect to crypto relative to gold. Now, crypto may get there. It's very early, as we know. They're still working out the mechanics of it. Likewise, crypto has similar ESG issues to not. Well, I don't like to use the word similar. It also has ESG issues, as mining does more generally, particularly on the use of energy and so forth. So clearly that will move like mining, as you say. It moves towards renewable energy and so on. So clearly that's something that will also be done. But we don't, as a house, we don't advocate clients allocate crypto into a portfolio. But what we do say is that as this space evolves, then there may be an opportunity at some point in the future that may occur. Just right now, we don't advocate clients put it into a balanced portfolio, for example. Whereas with gold, we do advocate that clients who can have an allocation to gold of anywhere between 5 and sort of 10% of the portfolio. And that also depends on what they have in their portfolio. So if you have a significant allocation to emerging market equities, for example, in your portfolio, you tend to have higher volatility, and gold can reduce that volatility in the portfolio and provide you diversification. We're not at that point yet on the crypto side.
Yeah, so it's a very good point to make on this portfolio allocation. So on crypto versus gold, you see. So do allow me to add on the portfolio allocation side. So you know that especially strong advocates on cryptocurrency. Like I got some of my mates who are very strong advocates of cryptocurrency. Those guys who attended last week's event. All right. So basically, what you see over here is that usually an asset class, either you are a return enhancer or a return diversifier. Okay, to reduce risk. So unfortunately, people say that crypto itself are a reduced diversifier. That means you're able to reduce risk. But the funny thing about crypto over here is that because of the mania that we've seen in the last 5 years, that means the amount of speculative element inside is so significant, it actually moves hand in hand like a growth stock. That means if you pull up a chart, if you do some quantitative analysis versus crypto, be it Bitcoin or Ethereum, versus the Nasdaq 100, in the last 1 to 3 years, they actually have a perfect correlation of close to 0.9. So the key thing, the funny thing over here is that in the near term, so I do believe that crypto itself potentially could see further downside pressure if Nasdaq 100 couldn't to come down, given that, don't forget, Nasdaq 100 has very huge capital allocation in portfolios because of everyone, fund managers, in order to be in line with we call it to the bid or the benchmark like S&P or Nasdaq 100, you got to have Apple And the last 3 years, you got to have Tesla. You know what I mean? So given that right now is that the amount of PE is so high in such company now, and the Fed itself is not stopping in hiking rates, we're now start to see a very severe adjustment in the heavy component stocks of Nasdaq 100, like Tesla, Apple, Microsoft, Amazon, especially Netflix. So this could actually eventually, right, psychologically and behavior add downside pressure to Ethereum. And on top of that, especially that those guys who are trading on a global macro perspective, like hedge funds, who are looking for a return of 3 to 6 months, all this could actually pile up to see a further potential downside in Bitcoin and Ethereum, at least in the near term. So unless we get a pretty much clear sign that the Fed is that, hey, we almost done our job, we're happy with interest rate at this level, maybe we talk about 5%, the Fed rate 5.5, and this is where potentially Nasdaq 100 and crypto could actually form at least we call it a medium-term bottom or some stabilization. Then from there on, we got to actually look at other stuff like geopolitical risks at play.
We have another question from the audience.
I remember when I was 35 and younger, and it was that I don't think that I cared about floors. You know, it was like I was thinking about things going up, like Bitcoin has gone again from dollars to $60,000. But I didn't think about floors at that level. I'm not thinking about, but now at 56, I've been through things where I realize that you can lose everything. And things that go up, a lot of times they come down. And I know that in China and India, they're going to be buying gold for jewelry. And, people care about in Switzerland, and other places in New York where I live, stockpiling gold. And it just feels like there's a psychology that there's some kind of safety in it. It used to back currency in a lot of places. And, a friend of mine took Bitcoin to El Salvador and got them to back their currency on it. I mean, it seems ludicrous to me, but just as a psychology, it does seem like gold has a floor. It's not as exciting. I get tired. I mean, I'm sure people 35 and younger get tired of old white people talking about, gold breaking 2000 and it never does. And it's, it's like, at least I own this. It's like something from my culture and my, and my generation, was going to adopt something new. But anyway, it feels good to have to have a floor instead of, and I don't think that a lot of these people at this age have gone through the cycles and seen, absolute busts, like probably most of us have. Anyway, that's it. I don't even know if that's a question, but nice to talk to you.
Well, they've known free money for the last 15, 20 years, right? Zero interest rates, low, liquidity, helicopter money. Maybe that money's made it into some of these things like crypto and there you go, right? And yeah, it's definitely competed against gold, though. I'll say that.
Yeah,
So we have time for one more question.
I'm sorry, but
That's all right.
it's kind of a continuation of what I asked just now. So the feedback I got from these young guys is 35 and below, they are not buying gold or silver, and I show them the prices of gold and cryptos, and I try to dig out on why such behavior exists. So my personal conclusion is the simplicity versus the complexity. Cryptos are easy to manipulate, to trade. Gold, we have supply chain issues, logistic issues, pricing issues. So my question is, how should we reduce these complexities on gold or silver within the industry to make it more acceptable by the young ones or whoever that doesn't know about gold and silver? For the record, I'm not a crypto buyer. I inherited the gold from my grandparents. So, but that is the doubt or question I have. Yeah, thanks.
I mean, just following up with really, I suppose, Derek's experience there of ultimately they will exceed a floor and they will ultimately experience a big loss. And I'm sure there's got to have been a lot of people with cryptos having gone up and coming down, there's got to have been a lot of people that have got burnt and probably wondering why. But I think something that you touched on about, it's ultimately going to get regulated. and given the regulators will be the old white men, as Derek refers, not you, Derek, is that going to sort of bring it in by default almost that you start and get that linkage, because older people like us have been through the peaks and the troughs, will say, oh, hang on, we've got to be a little bit more conservative about it. And we know regulation is conservative, which sort of following on from that question.
Yeah, I think that the key issue, I suppose, for regulators is if you need to look at this from a prudential point of view, but also from an ability to control monetary policy, because monetary policy is incredibly important to move, how economies, how demand or how demand contracts or increases and so on. And I think that's probably the key. Probably the two key things is around the countries begin to somewhat, and I use the word somewhat at the moment, but increasingly lose control of their own monetary policy, because people are merely transacting off the usual fiat currency. And I think that's why you've seen central banks, for example, exploring the idea of a digital currency to improve this. And this isn't about your question about gold, and I'll come back to that, but improve the overall or reduce the transaction costs of exchanging money and making that more seamless and making that almost cost-free. Because we all know we exchange currency. You go to another country, you come here from Australia, you use your credit card, the bank will charge you 2% for the pleasure of changing the currency. Now that costs 0.5%, right, or not even that, right? So these sort of things are going to come into the frame, but it's still very early days yet, and regulators are yet to really land on where this is all going to end. The point about gold is a really good one, because during COVID-19, the interesting thing about that crisis relative to any other crisis we'd had prior to that was that airlines stopped travelling. And the moment airlines stopped travelling, you couldn't back an ETF in New York because there wasn't enough gold coming out of the refiners in Switzerland. And this was where you saw these huge spread blowouts between London, New York, Shanghai, etc. And that was pretty. Our clients were fine. We had enough gold in the system to make those requirements of our clients who were buying physical gold at the time. But that is an issue, and the ETF side did allow people to begin to transact in gold much more freely than what had ever been the case before, because even silver's a big item. Part of the reason why there's not as much investment interest per se in silver, and I'm not saying that, it's because of its size and its weight and its size that it takes up in a vault, right? And so that creates this inertia that you're talking about. Clearly, there has been that move towards digital gold, where you can transact gold in a tokenized way, and I think that will begin to reduce this inertia, where you can hold ownership of gold, but you don't need to move that gold from its current location if that's vaulted somewhere, and so you don't run into these issues. But the issues around the ETFs is something that, luckily, Switzerland enabled those refiners to start. Luckily, airlines, governments started providing airline capacity that was able to then begin to move product again. So that squeeze was only very short term, but the squeeze is definitely there, and the problem has not been solved yet in that context.
Yeah, that's a very good point to make. So I think I don't mind if I ask to rephrase your question. So you did mention that your peers itself, you found that trading cryptocurrency is much more easier versus trading a traditional asset like gold and silver. So I believe that one of the reasons they find it easier is easier to access the price of crypto and cryptocurrency, right? I mean, you can just open your handphone, you download certain app, and you trade it off there. So do you mean by this aspect? Yeah. So from this, if this, so, yeah.
maybe the simplicity is more on what they are aware and what they know of, because gold is for centuries,
Okay.
cryptos less than 10 years.
Precisely.
This is what they know versus what's on a book. So
precisely.
simple and
Correct.
complication.
So basically, I'm just answering from a retail investor, retail trader perspective. Yeah, definitely, because you're talking about the volatility of cryptocurrency is going one way up in the last 5 years. We talk about Bitcoin easily could go up 50% in 2 or 3 days. So that actually enticed a lot of retail brokerage advertising cryptocurrency like Bitcoin, Ethereum. So that causes the younger generation to be much more afraid of cryptocurrencies. Then people say, hey, why should I be bothering about gold and silver? That's not moving. At the end of the day, retail brokerages don't earn any money out of it. So I pump all my marketing effort into cryptocurrencies. But if you look at the fundamental aspect of cryptocurrency, because I have a couple of mates working actually in DeFi. So the beauty about cryptocurrency is that if you ask the younger folks, do you understand what is the technology that's backing cryptocurrency? Okay, it's not some fanciful, monkey pixel picture at the back of some JPEG. It's actually blockchain technology. Okay, so the funny thing about this blockchain technology, they call it distributed ledger, it's still not so productive and efficient. So if you want to run a particular, we call it exchange traded platform, running DeFi, that means using blockchain technology, you got to plug in this MetaMask API, and you compare to a traditional broker like TD Ameritrade, or they call it Ting or Swim, or any local brokerage, you'll be surprised. The traditional broker could actually execute your share, be it in gold or be it in FX, because DeFi is also running on FX, but running on a blockchain technology. It takes a quicker time to run on the traditional brokerage compared to a brokerage that's running on DeFi. So the key thing behind about why some of the younger folks, they actually get confused because at the end of the day, they feel that it's hype. It's the pop culture right now that causing this. They found that, hey, it's easily tradable. But in fact, the true fact is that the technology itself is still, it's a very infancy state. It hasn't hit the stage that where it could actually compete with traditional finance or even being as efficient as gold or even mining of gold and silver.
So I'm just conscious of time. We've gone into the red here in our timer. Really interesting conversations you guys have been having so far and completely taking over my job, so thank you. Some final thoughts from our panelists. Precious metals moving forward, maybe in 1 or 2 sentences. Let's give some thoughts for the future.
Okay. Well, for me, in the near term, I still view as gold because as there's still potential downside due to the Fed policy, which eventually showing this dollar strength that will be a trend persistency on the upside. So we're talking about key major support levels to watch on gold, means gold versus USD. I'm looking at 15.50, 14.45.
Yeah, look, on the silver perspective, I think we're going to see more of this delinking with it as a precious metal. And really bring it home, Wayne, with, it's 82 silver bars to 1 gold one, and where do you put it? But then equally, I think the great thing about crypto is they're going to need lots of silver in the systems to run it. So I think the future for silver is good, but not so much as a precious metal, other than have a few coins at home.
I guess from my perspective, it's a long-term view and a tactical view. The long-term view is from a portfolio perspective. We see gold as still a great diversifier in a portfolio context, and at times also other precious metals such as silver. So we see that allocation to gold going forward on a long-term basis. But tactically, don't buy gold yet because the Fed is not done. And when the Fed, either the labour market begins to deteriorate more rapidly than they expect, or the Fed say, okay, we're going to wait and see, then have another look at gold.
Very dependent on Fed policy, interest rates, dollar strength, expectations for further hikes. expectations for inflation, but watch the swap traders. Swap traders are betting that by March of next year, rates are going to start to go down again. Those are the bets. That's public. Go look it up. If they're right, gold's going to move.
All right, some great predictions.
Silver as well, by the way.
Silver as well. Hey, we got silver too. I'm all for silver as well.
All right. Thank you to our panelists for that really interesting discussion. So Calvin, David, Wayne, and Sean, thanks for joining us today.
Thank you very much.